Hey guys, welcome back to the channel, best place for long-term stock investors. Speaking of long-term stock investors, today I will be talking about Warren Buffett. I think it's not a secret that we are big fans of him, and a lot of people have been asking us about what our thoughts on Warren Buffett are. So I'm going to share all of them with you today. What are some of the things that steps you can take if you want to become like him? And let me tell you, it's not going to be easy. And as usual, guys, none of what I say should be taken as financial advice. If you want that sort of advice, please speak to a professional. Alright guys, if you didn't know, we have a free masterclass just for you where we train you how you can build a 6 to 7 figure portfolio using the power of stock investing. If that's something you're interested in, you can sign up for the masterclass in the comment section or the description. Okay, for those of y'all living under a rock or you maybe don't have internet, who is Warren Buffett? Many consider him to be the greatest investor of all time. He has done it through a vehicle called Berkshire Hathaway, one of the greatest, what we call capital allocation stories ever. In 64 years, right, he grew his money 160,000 times. Yes, you're right, it's not 167, it's 167,000 times. And you know, when I first saw this and when a lot of people see this, the immediate question that they get is, how do I become Warren Buffett? Naturally, right, how can I get a taste of his success? And then some people say, I just need 1% of his, I don't know, $100 billion wealth or whatever it is today. Now, you have to know this, right? There's actually this thing called the Buffett curse. So guess what? Whenever, a superstar investor does well because, partly because they follow Buffett, what happens is that some news publication will suddenly say, hey, this is the next Warren Buffett. And it's actually a curse because right after that, typically something bad really happens. So to give you two examples, the first one is Eddie Lampert. He actually started a hedge fund at 25, right? That's crazy. And then by 2004, he was generating like 29% returns, right? Making big money. 2004, he was called the next Buffett. And then he bought this company, right? During the financial crisis called Sears Holding. You can go and Google the share price today. It's not done well. He has tried to chop up the company and sell them left, right, and center. Couldn't really do it. But essentially, that's what happened. And then you've got Bill Ackman, a much more recent example, made $1 billion in 2014. Forbes started calling him Baby Buffett in 2015. And then he made two very big and bad investments in Herbalife and Valiant, which lost his firm, Pershing Square Holdings, many, many billions. So really, the mountain to climb to become like Warren Buffett is very, very steep. As you can see, people who are highly educated, highly talented also can't really do it. So the question is, how can you do it? And I'll share with you that in the next segment. Alright guys, if you're interested in working with us on a private one-on-one basis to improve your stock investing skills, we have the perfect solution for you. That is our Mentorship Program. You can actually apply it in the comment section or the description. Now, key thing is that not every one of you will hop into an interview. Only 20% of you ever get to be interviewed by us. And even if you actually hop on the program, it's an exclusive program. But if you're interested and if you're confident that you can qualify for it, go ahead and apply. Okay, so what does it take to be Warren Buffett? Now, this is not my point of view, or at least only some of it is. This is based on many smarter people than myself. Obviously, I'm not Warren Buffett, but here are some of the tips, right, that other people have looked at Warren Buffett, tips from Warren Buffett himself, to give you a hint of what does it take to become like him. The first is that you need to stick to an investment style without concern for volatility. You see, the market is changing all the time. The market is cyclical, and there's a lot of emotions in the market. A lot of the emotions is driven by volatility, the choppiness, how the stock price yo-yos, right? And of course, what happens when you leave this to purely your feelings, right? about the stock market. What ends up happening is that you start doing the opposite. You start buying high and selling low, right? Because when it's high, you feel a momentum, so you buy more. Then when it's low, that's when you start selling and things like that. Now, even the reverse can be true. You buy a stock that's gone down, or you're holding on to a stock that is like down 50%, and you think like, how much more can it drop? Or perhaps you're like, no, I think this is going to come back. I'm going to sell it once it hit my cost, right? But then by the time you hit your cost, you actually start buying more, because then you're like, no, but the momentum is up. I waited so long. Now here's my time to reap the rewards, whatever it is. So that is something that, someone like Warren Buffett is really good at doing, right? He has an investment style, A, B, and C. Doesn't matter what the market condition is, he sticks to it. Linked to that, he doesn't buy and sell based on panic and euphoria, right? Emotion is not the driver. Sticking to your investment style is. Number 3, this is a big one, obsession. So the problem with most people coming, in my opinion, that people come into the market is that they think that it's a place that that is safe, and they can just park their money and forget after 20 years and they're going to do well. The fact of the matter is, stock market is like a game, right? Things change, rules change, you have to adapt whilst not abandoning, right, the general principles of your investment style. And in order to do that, you need to be obsessed, because you need to really be laser focused on the investments that you're making. Linked to that is learning from mistakes. This is something that not a lot of people can do, as we can see with the recent, in Malaysia's case, the glove rally and crash. Some people just keep holding on to opinions that doesn't make sense. I still remember at the peak, like 15 times, people were saying that it was like 5 times PE, it's like very attractive, but as we know what happened with gloves, right? So learn from mistakes, very, very important. Common sense, this is also absolutely key. I think, so, learning from your mistakes, panicking and euphoria and all that is something that affects all of us. But I think common sense actually affects people who are more educated. Ironically, it is the people who know the jargons, who know the technicalities, who know all the accounting and financial figures and all this information, that start to lose common sense, right? Because there's so much information and they just want to try and understand everything as a whole, which then leads them to have, very, very complicated ways of understanding the stock market. And that's when they start losing common sense. And that's when their investment thesis and investment style start to change all the time, linked to point number 1, right? So again, common sense, very, very important. Now, this next one, strong opinions, loosely held. So the stock market, you need to have conviction, right? You have to say that I think this stock is going to do well, or I think this stock is going to do badly, and things like that. But you need to hold them loosely. You need to focus on the facts, and when the facts are there and the reasoning is good, you bet big, right? You have conviction. But when things start to change, you have to be able to change as well, right? Strong opinions, loosely held. Warren Buffett is very good at that. He can put in billions into something, but if the facts change after 1 year, he'll sell everything. Good case in point would be, in his case, the airlines. He bought it, I think, 2015, 2016. He was very excited about it because the industry was consolidating, which meant that profits were going to go up for the industry. But then COVID hit. That changed his mind. Even though he was losing, he just cut it, right? Strong opinions, loosely held. Hey guys, enjoying the video? If the answer is yes, remember to like, comment, and subscribe. Click on the notification bell so whenever new videos pop, you'll know it fresh. So now here's the thing that we all have to understand about, looking at experts and learning from them. It's actually very hard to replicate their strategy and to ask yourself, like, okay, what is the best way to invest in stocks, right? How do you pick the right management, the right valuation, which are the numbers that are the most important, which industry should? It's actually very, very difficult. So I would suggest a very different method of learning from other people, and that is this concept called via negativa. Okay, it's a fancy Latin word. Basically what it means is that you learn from someone not from what they do, but what they don't do. Negativa, right? So here's what Warren Buffett doesn't do, and this is something that you can very easily replicate. The first is that Warren Buffett is very, very debt resistant. In fact, for most of his life, the big loans that he has in personal life is really his house, which he paid for like $30,000 US, a long time ago, right? So that's really what he is like when it comes to that. And when you look at his company, I know some of you will be like, oh, but Berkshire Hathaway is a lot of debt. Yeah, it does, but you have to understand that these debt are used for things like Burlington Northern Santa Fe, which is their railroads. And these are quite what you call physical assets, which is very cash generative, so that is not really an issue. But by and large, that is, especially when it comes to investing in volatile assets like stocks. Now, the second thing is that reputation is king. So do nothing to damage it. It's as simple as that, right? This is a very simple point. Not much else I need to say. He never stayed in one spot, right? He evolved. He constantly evolved, right? He used to start off as what we call a net investor under Benjamin Graham, like hardcore statistical value investing. Move on from that, learn from Charlie Munger, became a business investor, bought companies with higher PEs, higher price to books, but he knew that in the long run, the company would generate more cash. And that has resulted in his stellar 64 years of investing results. He's also very self-reliant, right? He doesn't listen to other people's tips. He might call experts to ask them about certain things, but really the decisions is his, and he realized that it's his responsibility to manage his money. So he doesn't blame other people. He doesn't refer to other people as his investment benchmark. And that's something that you should be doing as well. I should be doing as well, being more self-reliant. And that also means not listening to us in this video absolutely blindly, right? This next one, no burnout, right? It's passion, right? He really loves what he does, so he can work long hours at it without feeling like, oh, I'm wasting time, or I'm like very drained and I dread doing the work. I think that's really helpful, because the more you can enjoy the process of investing, the more you can do, and of course then the more you improve, right? That goes without saying. And the last bit is that he survived. I think he focuses on survival and not on making the big returns, right? For him, is as long as I survive year after year, decade after decade, I know I'm going to get returns. The question is how much, and that depends on skill. But before that, right, it's all about discipline. It's all about survival. So now you obviously, the title of this video or the thumbnail, right, indicates to you that actually really you can't be Warren Buffett, right? As much as you can learn from him, read his books, read his letters, hear his speeches and whatnot, the thing is you really can't be him. And let me tell you why, right? Here's something you need to understand. 3 things actually. The first is that he was born in the 1930s, right? He was white and he was male. So when you're a male in the 1930s, you don't have females competing with you in the workforce. That makes your life a bit easier. Number 2, he is white. In the 30s, there was a lot of racial issues in America where blacks, non-whites, can't really compete as well as whites due to law, right? Not because of talent or skill. So that's a massive advantage, right? When you've got a big chunk of the population not being able to compete with you. Number 2, he is, by some people's estimates, to have 150 IQ points. Now, maybe you don't know anything about IQ, but let me tell you this. 150 IQ is only 10 IQ points lower than someone as smart as Einstein, Albert Einstein, the famous physicist. Okay? The average person in the world has an IQ of 100. I think Malaysia is 90-something, sad. But basically, he's way above the average. And that is something that he didn't have, and a lot of us won't have, right? Something to know. And the last bit is in terms of his upbringing. Warren Buffett's dad, right, was a senator for the Republican Party, so he was well connected. Number 2, the father also had a stockbroking business. In other words, as a young kid, he was already exposed to stocks. He was exposed to accounting numbers and stock tickers and all that. So it's in his blood. Few of us will ever have that opportunity. I mean, I've only got into stocks when I was 20 years old, right? That's early on average, but that's still not as early as Warren Buffett, which is probably like single digit age, right? At maybe 7 years old, bought his first stock 11. So anyway, the point I'm trying to tell you here is, guys, as much as you can learn from Warren Buffett, don't think that, wow, I'm going to have his wealth and his track record. Because in order to have that, you need a lot of things that Buffett himself didn't do in order to achieve those goals. He didn't do any of this, right? He didn't choose when he was born, the IQ he had, and the father they have, certainly, right? I'm sure some of us would like to choose our fathers, right? But you can't do that. He didn't do that. A lot of it is luck, and I think that's the key message of this video. Guys, hope you enjoyed the video. Let me know if you agree or disagree in the comments. Do you think it's more about hard work, talent, or skill? And guys, watch some of our other videos, and I hope to see you in the next one.